I hope you're in position to see my screen.
I can see.
Yes, okay. So please take note that this area doesn't normally miss in our paper. So it is good to really master the theory. Almost every paper you'll find that there is a theory question around this area. Okay, if it is not a computation, there is a theory. We are going also to have a session about computations. Then that will be all about this topic. We are really going to be attempting these questions. By the time we end the session, we will be in a position to answer all questions. Since it is basically revision. So we are going to start with a question that was asked in November 2018. That is 5B, where they are telling us to discuss many features of the share buybacks and stock splits, and we go ahead and explain why this entity may use them. We also, in our explanation, we include the impact on the share price. I may not be opening the questions, but really that's where I picked. I know that you have the question bank already. So really that's what you'll find when you open in November 20 what? When you open in November 2018. November 2018. That is the question you're going to find when you open what? Just that here I didn't include the marks. Now, the aim is not really to discuss simply the revision. It is to prepare ourselves for our paper. In a scenario where we find that question in our paper, how can we approach it? How can we really claim all those what? All those marks? That question was taking 14 marks, colleagues. That question was taking 14 marks. It's not that you will need to just focus on computations. You don't need to focus on only computations when it comes to this paper. Let's carry the theory. This is November 2018, and me, I am focusing on only theory this session. I am not going to do the computations. For the computations, we are going to discuss them separately. We will have a separate session for the computations. So here it is part B of our question 5, where they are telling us to discuss the main features of share buybacks and stock splits, and why GML may use them, and why GML may use them. So let's really start and see how we can claim all these marks. So I am going to start with November. I am going to start with this good question, and we see. Already I remember when we were discussing the dividend, I highlighted about stock split, but I'm going again to discuss about it. So we are going to start with share buybacks. Share buybacks. That's what I'm going to start with. Share buybacks is like share repurchase. This is like share repurchase. This is like share repurchase. So now this one, since you are looking for 14 marks, you really need to try to explain it. First of all, what is share buyback? What is share repurchase? Before you look at the what? Before you look at the features. And why do you think that the management, the entity may use them? It is very, very key as you try to answer the question. Okay, so share repurchase. This is the process by which a company buys back its own shares from the existing shareholders. So you are buying back your what? You're buying back your shares from the existing shareholders. And when you are buying back these shares, it could be either that you are using, it could be either through what? It could be either through the stock market. That is where you have the open market purchase. Or it could be that you're buying them by making a tender offer at a specified price. So if it is not through stock market, then you may just simply make a tender. You just express your interest, okay, to buy these shares from the existing shareholders. So always take note that when you repurchase the shares, they are in your books as an entity. Those repurchase shares, you may cancel them, or you may hold them as treasury shares. And the moment you find that you are canceling them, it means that they are not outstanding shares. You may cancel them in your books, or you may put them under the under the treasury shares. Whatever is indicated under treasury shares, whatever is cancelled, it will have an impact. It means that actually we don't have many shares in existence. So that is basically the share repurchase. We are buying back our shares from the existing. The key word is that we are buying back our shares from the existing shareholders. Okay. Now we need to know what are the main features now. The main features of share repurchase or share buybacks. What are the main features of this share repurchase? We can say that one is that the entity or the company purchases its own shares. You are really purchasing your own shares. Okay, you are using your cash. Okay, here the entity, the company uses its available cash or borrowed funds to buy back its issued shares from the existing shareholders. It is very, very key that now here you are using your own You are using your own money, or it could be that you as an entity, you borrow the money to buy back these shares. That is the first feature. You are buying back your own You're buying back your own shares. So instead of paying these shareholders dividends, the company may return money to the shareholders by purchasing their shares. So it's always one way how these shareholders can actually get cash from the entity. If they are not receiving dividends as shareholders, then they may decide to sell their shares. They may decide to sell their shares through the stock market. And that's when the entity may say that if the existing shareholders is willing to sell the shares, let's buy back. Let's be the one to buy these shares from this existing shareholder. So I may need money as a shareholder. You are not paying me dividend, but I need money. So I may decide to sell my what? My shares. So the question is, are you the one buying shares as an entity, or there are other shareholders buying those what? Buying those shares from the existing shareholder? So it is very, very key that you need to think about that. How the shareholders may get money from what? From the entity, from where they invested, either through dividends or through selling those shares. And if they are to sell shares, who are buying them? Okay, then number two, the main feature is that it reduces the share repurchase, reduces the number of shares outstanding. The number of shares outstanding. Very, very key. Once shares are repurchased, and cancelled, it means that few shares remain in circulation. In circulation. It's something that you needed to know. That at the end of it all, it means that your profits will be shared among a few shareholders, and each remaining share represents a large what? A large share ownership. If we reduce the number of shares, what will happen is that the EPS will become high. The EPS will become high. It's also another feature that it increases the what? The EPS. Because EPS you are getting the what? The profit after tax over the number of outstanding shares. So it means that if the denominator is lower, it means that this EPS will increase. So this share purchase has reduced the number of shares, and at the end of it all, our EPS will be what? Will be high. That's something that is something that you can also add. Another feature is that it increases the EPS. It increases the what? It increases the EPS. Remember, many features, you're simply talking about the share purchase. You don't need to struggle. With points. As long as you know the impact of this share purchase, you can really know what? You can really know the points. Then next is that the main feature is it could be that we have changes in the what? It changes the what? It changes the capital structure. How share buybacks reduces what? Reduces equity. It's another point that you can put, because when we look at our equity, it means that now it will reduce. But if you realize that this share repurchase is financed by debt, it means that debt to equity ratio will increase. It will increase. If the model of repurchasing, if they have used the debt to purchase, it means that the debt to equity ratio will increase. It will really increase. Okay, then what else can we put? Another feature is how you are purchasing them. The main feature of this share repurchase, it can be conducted in different ways. How we are saying that it can be through, that is, it can be through, we can say maybe through open market purchases, or it can be through the tender offer, whereby the shareholder, whereby you're offering the shareholder a premium price. You're trying to offer a higher what? A higher price. Here you are offering what? You're offering the shareholder, the existing shareholder, a premium what? A premium price. If the nominal value is this, now for you, you are increasing the nominal price, okay? So that they can be motivated to sell. Or it could open market purchases is where the existing shareholder decides to sell their shares in your company, and you decide that let's be the one to buy these shares. Or it could be around the private negotiated purchase where you rearrange. Okay. So really the method chosen depends on what? Depends on the company's objective and the market conditions. The method you can use. So that is another feature. Remember here you are trying to gather marks. You're really trying to gather marks. Write what you know. Write what you know about share repurchase, because these are main features. Whatever you write, as long as you defend yourself, you will be correct. You will be correct. But we can maybe try. You can maybe try to say that this share purchase. Another thing I can say that it improves the financial ratios. It improves the financial ratios. Maybe this point, let me not put it here. I can put it here another way, or I can say it improves, or it improves the financial ratios. Another student can say it improves the financial ratios. One financial ratio you're talking about is EPS. EPS increases. Here, as we have seen that the EPS increases. At the same time, there is also another financial ratio called return on what? Return on equity. Return on equity also improves. Return on equity also improves, because the total earnings remains unchanged, but you find that you're dividing those things by the what? By the few shares. So that is how many points. I don't need to overstretch, but what else can you write? What else can you write? It's another one. It's another. Someone has a point?
Yes. Question. Now, if you're buying these shares from your profits, then that like reduce your liquidity, your cash. That a feature.
You are a bit here. Be near to your mic.
Yes, I'm asking if we are buying with like cash. If we are rebuying these shares, what doesn't it reduce our liquidity?
Yes, it reduces your liquidity. Yes, that is also another point. If you're using cash, so you bring it reduces the what? The cash available. It reduces the cash available for a viable what? Viable opportunity, viable investments, especially if cash is used to repurchase the shares. Is it okay? Is it okay?
Yes, that's fine. Thank you.
So here it is in line with what? It is in line with liquidity. Let me hope that is the point that you wanted to make. It is in line with liquidity. Yes, you can also bring that. You can also bring that. If you're using debt to purchase, then it means that from your in your financial statement, yes, equity has reduced, but your debt has increased. So you can also bring it from that way. Also, another student can say that it is another alternative method, of returning cash to the existing shareholders, rather than distributing the profits, that is dividends. Company can return excess share through what? Buybacks. Through buybacks. Instead of paying dividends, you can return your money through what? Through buybacks. Okay, I think these are enough points. Maybe I can add the last one. It may signal what? It may signal undervaluation from the management's perspective. Management may what? We can say that management may repurchase shares because they believe the market is undervaluing the company's shares. That is also another way you can explain, because that, if also here, it also signals good news to investors maybe as well. Because if you are buying shares that we think that maybe they are undervalued, then it is a positive what? It is a positive signal to investors that management has confidence regarding the future performance. That is also another way. So all these points we are putting, in your sense, you may be saying that, but as if we are not answering the question. We are answering the question. Many features doesn't necessarily mean that you talk about specific things. Just write what you know about the share repurchase. Write what you know about the share repurchase. Because whatever you're talking about, whether it is advantage, whether it is a demerit, whether it is the definition, you are really talking about the features. So don't limit yourself by saying that I don't know the features. Simply write what you know. Okay, so the question is, why do you think the entity may use them? Why do you think the entity may use share repurchase? Why do you think the entity may use a share repurchase? Why this entity called the GML may use share buybacks? So now here, why? You are answering the demerits. In your mind now, you are not really focusing on from the angle of demerits. Demerits may come here, and actually you are going to realize that with these kinds of questions, the points you're putting here, some of them can as well be indicated here. Because here with many features, you may, depending on the marks, like now marks are 14 marks. Really, you need to write like 4 marks, 4 points here. You need to balance 14, 7, 7. So here you need to write like 3 points or 4 points. Here 4 points can come from the definition and the merits and demerits. Some pick anything that you know. Then why is that we are deciding to really return the surplus to the shareholders? Why is that we need to return part of the money? Part of the money, it's another way of returning part of the money. You return the surplus cash. the excess cash to shareholders. Where we find that we have excess cash, if we realize that we have excess cash as an entity and we have limited profitable investments opportunities, then buying back shares may allow this entity to distribute excess cash efficiently. Remember here, it could be that you as an instant shareholders, you have analyzed the taxes, the tax on share repurchase, and also the tax on dividends, and maybe depending on how the impact of the tax, then you realize that now we take a decision of returning this excess cash also from the angle of the tax or from the shareholders' preferences. For them, they are preferring to receive their money in the form of you buying the shares instead of dividends. Why we use share repurchase could be that we want to increase our financial ratios. We want to increase our financial ratios or to improve our financial ratios. Let's say EPS, we want to increase the EPS. As long as we have fewer shares outstanding, it means that our EPS will be high. That could be another reason. Why also we use share repurchase could be that we want to increase the shareholder value. And now the shareholder value comes from the fact that the entity believes its shares are undervalued. So repurchasing them allows the remaining shareholders to own a large proportion of the business. That ideally increases their value. Okay? You repurchasing the so-called the undervalued shares, it helps the remaining shareholders to own a large portion of the business, and their value as the remaining shareholders will increase. That is also something that you really need to know, that if we repurchase, then the few that will remain, their value will increase. Okay? Another way it could be that they want to achieve an optimal capital structure. An optimal capital structure comes in a scenario where an entity has excessive equity and they have, let's say, relatively low debt. So they decided to buy back using equity. They buy back the shares using equity. Using debt. They buy back the shares using debt. So it means that here, when you buy back using debt, you're reducing equity. You're simply reducing equity, and you're increasing. That in that way, you are optimizing your capital structure. Okay, you have the debt to equity mix. So this will lower the what? This will lower your WACC, your weighted what? Your weighted the average cost of capital. If that is your aim, then you can also try to do that. You have excessive equity and you want to balance. You have excessive equity, you don't have too much debt. So what you do? We reduce our equity by buying these shares, then we using the debt and we increase the debt. I hope I have explained this. Remember, there is advantage from the tax angle. If you have too much too much, if you have excessive equity, in terms of the taxes, someone who is using debt will be saving on the taxes compared to someone who is financing using the equity. So it could be also from that angle, because if you're using debt in your business, it means that you're claiming the interest on loan. You're claiming the interest on debt. But in your tax computation, there is that expense. But someone who is using equity, you can't put dividends under expenses. So it means that now your taxes are high compared to someone who is using a debt. So you find that entities want to optimize that through restructuring. So they reduce equity, they increase debt. Also with that, also from the management perspective, also you're trying to lower the weighted average cost of capital in the long run. Then next, why? Guys, this question may come. Why is that we want to prevent the hostile takeovers? Very, very key. We want to prevent the hostile takeovers. Okay? Reducing the number of publicly available shares makes it more difficult and expensive for potential acquirers to obtain the controlling interest. Remember, we are buying back the shares. So it means that the shares available are few. And probably now it means that we have more control. At times, if you don't buy back those shares, other guys may target and end up having control, taking over the control in your company. You are trying to prevent that. You are trying to prevent that, to make sure that the number of publicly available shares, even if these existing shareholders want to sell, we will find that we have less we have few shares outstanding. And even if other acquirers buy, they will not have the significant control. So you are trying to prevent, using share buyback, you are trying to prevent the hostile takeovers. Okay? I hope this point, please, if the point is not clear, let me know, I can repeat. Then, what else? Are they enough? I really think they are enough. I really think they are enough. Because you really find that also this supports why you do this is that it supports the share price indirectly. Because where the share price is temporarily depressed due to, let's say, market conditions rather than the poor company performance, you may find that really your share price is low due to these market conditions that are temporary. But you know that in terms of the company performance going forward, you may improve, then it can help you, it can save you. Let's buy back our shares, then we aim at improving, we aim at performing better. If we perform better, our share price will increase eventually. This is really temporary. The lower price we have now is temporary. If we buy and we aim at performing well, going forward, our share price will increase. And there will be demand for our shares. As long as there is demand, our price will increase. Wherever there is a demand, price increases. Wherever there is a good performance, people are interested in your entity. Okay, and now the price will be okay. So all these points really can help you. let me not overstretch. Let's stop here, but you can put all other points, It's a signal, it signals management confidence. That is another point that you can put. But I also want to bring something that is really clear. When you are discussing this, think about the impact. The impact, because in other question, they can say we explain the impact of share repurchase, on share price. They can also tell us to explain, and they say for Max, what is the impact of share repurchase? But generally, the impact is that it increases the share price in the long run. It really increases. It really what? It increases the share. It increases the share price. But that is not always guaranteed. It's not that it automatically, when you do the share repurchase, your share price will increase. It will depend on the reasons. This share price may increase if there is increased what? If there is increased demand. If there is increased demand, as the company purchases shares, we find that in the long run, the demand of those shares will be high. If there is reduced supply of shares in the market, that one also increases the price. If there is higher EPS, that one is okay. If there is a positive signal, that management believes shares are undervalued. If you really know that, if also it comes to your mind that management believes that these shares are undervalued, highly likely you will have interest in that one, in buying those shares. And every time you have confidence in an entity, also for them, they will price their shares at a higher figure. Okay. Now, okay, even the thing of improved confidence. Now, please take note that if the investors themselves believe the entity is buying back the shares because it lacks profitable investment opportunities, or is simply using the excessive debt, the positive effect may be eliminated or even reversed. Because you as investor, you need to think about these things. You as an investor, yes, these guys are buying back shares, but what is the mode they are using to buy the what? Are they using the debt? Or they are using the excess surplus, the excess profit? You as an investor, you are really focusing on this. If it comes to our attention, if it comes to my attention as an investor that they are using debt, or they are using excess profit, or now if they are using excess debt, I have something to worry. If they are using excess profit, I also have something to worry about. Probably they don't have what? Probably they don't have the profitable investment opportunities. Why would you really buy back the shares when you have the profitable investments to invest in? Remember, my focus as an investor is that I want to invest in an entity that have profitable ventures. because in the long run, I will be in a position to have what? To have more dividends. If the entity performs well from those investment opportunities, I will have much dividends. So you, at times, yes, you may think that it is a positive signal because you believe shares are undervalued, but at the same time, this image may be perceived in a different way. So if it is you're using debt, now it means that this entity is highly geared. It means that this entity has too much debt, and that is a financial risk. You will be paying too much interest to clear instead of focusing on investing that money. So those are things really, as an investor, as a manager, you need to think about. You need to prove that that is not the case. Okay, so that's what I can say about share repurchase. Let's move to the next. In case you have a question, please ask. Please ask before I go to next. Please ask.
I wanted to know which topic is this, where we can get.
Now the top capital reconstruction. Remember the heading, eh? The heading is, theory question is on what? Corporate restructuring.
Okay, thank you.
You get? The heading is on corporate restructuring, mergers, acquisitions, or capital reconstruction. Capital reconstruction, eh? It's where you are trying to rearrange your capital in different ways. You are rearranging. It is a financing strategy that instead of financing our entities using equity, we can use debt. Or instead of focusing on debt, we can focus on equity. Or we can decide to sell. So you are going to find that under capital reconstruction, we have too much things. That's where you will find that management buyout. That's why you will find that leveraged buyouts. That's why you're going to find that the spin-offs. Like it's a core topic. I believe you have also seen that it is a core topic. If you have been following. My colleague who had asked, is it clear? My colleague who had asked, is it clear? Nato Yogera?
Yes, it is clear.
Okay, so let's also clear the stock split. Do you recall what I said about stock split? But why are you not using your name? What happened? I am seeing this ZTE. I don't know what is your name, eh? Why are you not using your name? So stock split, who can recall what is stock split?
If I recall, it's when management, they plan to increase their shares by dividing the shares they have currently into multiple shares.
Wow, that is
Something like
really
that.
very correct. That is very correct. But there is another word that I'm waiting. Add that word that I'm waiting for.
That's an I've forgotten.
Okay, so we can say that this is the a strategy, or we can say a corporate action where the words you can even say this is where this is where a company. So if I have used the corporate action, okay, let me just say this is where the company. This is where a company increases the number of shares in the issue by dividing each existing share into several new shares, while how can I say, while what proportionately reducing the market, reducing the price per share. Okay, let me try to simplify. What is the spelling of proportionately? Proportionately. Okay, this is where a company increases the number of shares in issue by dividing each existing share into several new shares, while proportionately reducing the what? Reducing the price. Now, with stock split, yes, we are doing this, but at the end of it all, we are saying that the company's total market price, total market value, or the shareholders total worth remain unchanged. Immediately after the split. Now, when you recall what I really gave you last time about dividend, because I remember we really discussed this, I even gave you the explanation. Are you seeing this? You are trying to convert the existing shares into multiple shares. But the aim is that we are not changing the total value. You are not changing the what? You are not changing the total value. And it means that what will happen is that you want to maintain, I can again remind you, you want to maintain the total value of 10, but increasing these shares. Maybe instead of 2 shares, you want to have 10 shares. You want to have 10 shares. You want to have 10 shares, but keeping the total value the same. So it means that here what will happen, the price of these shares will not remain as 5,000. It will proportionately reduce. It will proportionately reduce. So what will happen is that you're getting 10,000, the total value divided by this, and now the share price each is at how much? At 1,000. Do you get what I'm trying to mean with stock split? Is that you are you are converting the existing shares into multiple shares. we are converting these 2 shares into 10 shares, but keeping the total value the same. But this, by doing that, you are proportionately, you are reducing the share price. You are really reducing the what? You are reducing the share price. Because if the share price was 5,000, now the share price is 1,000. That's what we are trying to mean. And I can tell you, colleagues, when you know this, even the points can come out clearly. Points can come out clearly. The advantages, the impact on share price, you really know that points can come out clearly. Points can come out clearly. Okay, so what's what is being seen? What screen are you seeing? So, so main features. Can you tell me the main features? I really don't want to, because already you know what is the stock split. I believe in an exam you can cook some of the points. Key point is to always know, if you're talking about stock split, do you really know stock split? If you know stock split, then you can cook these points. One is that it increases the number of what? Increases the number of shares. It's one of the main features. It increases the number of shares. Very, very key. It is really very, very key that when you do stock split, you have seen that it increases the number of shares. Each existing share is divided into multiple new shares. That is number one. Then number two, it reduces the market price per share. You saw that. It reduces the market price. You saw that. I don't need to again explain it. Then number three, you saw that there is no change in the overall shareholder wealth. You saw that there is no change because the total value is going to remain the same. There is no change in the shareholder wealth. There is no change in the company value, because here we are saying that the total value will remain, because here the total value will remain unchanged. It will remain the same. The number of shares have increased, but the share price has the share price has reduced. So because of that, you have the price remain the same. The price remain the same. Okay, what else can we put? It improves affordability. It improves affordability because the share price has reduced. It means that your shares become affordable to more investors. Your shares become affordable to more investors, and if more investors can bring money, it also improves indirectly. It improves liquidity. It improves liquidity. This one improves liquidity. Why? Because the more investors can participate in the trading. Because these shares are cheap, more investors will be in a position to bring more money. So you see, points can come out clearly. So why this entity GML may use stock split? Why do you think this entity may use stock split? Why is that we want to improve? We want to improve the what? We want to improve the affordability. This is not like share repurchase. Here we are trying to encourage people to buy. We want to improve the affordability. Okay? If this entity's share price has become very high, if we realize that our share price is very high, it means that many investors may struggle to purchase our shares. So we do a stock split that will lower the share price without reducing our value. So it will also increase the liquidity. It will also increase the liquidity. Also, it improves the liquidity because lower priced shares attract more buyers and sellers, and all that increase trading activity. So this increases market liquidity actually. Market liquidity. You are going to find that with low priced shares, more buyers will be there and more sellers will be there. And that actually increases the trading activity. What else can we really say? What else? Hey, yeah, we can say it improves liquidity. It improves liquidity because low-priced shares attract more buyers, and those buyers will be in position to bring in more what? More cash. Then here we can say it increases it also improves the marketability. Because here it means that shares trading at moderate prices actually are more attractive. In the market. So you find that in terms of the market performance, the sales are high. Okay. But at the same time, it signals what? It signals confidence. It signals what? Confidence. Management usually undertake those stock splits when they expect a continued growth and believes the company's strong performance will continue. That is also something that you can think about. And also another thing is in terms of maintaining to maintain an optimal trading range. You are going to find that companies often prefer their shares to trade within a price range that encourages market participation. So if we realize that our prices is not within our preferred range, then we can see how we can put our price to be within our preferred range. And how can we do that? We do the stock split. If the price is outside our scope, then we do the stock split to be within our preferred scope. Okay, I think those are some of the points that I can put. Then, of course, the impact of this, if they ask you the impact of stock split on share price, I believe you put a point. Don't forget. We saw the impact of share purchase on share price. What is the impact of stock split on share price? The immediate impact is that after the split, the price per share decreases. The price per share decreases. That one you saw it. I don't need to repeat. Okay, because you are trying to maintain the total value. You increase the what? You had 10 shares, each at 5,000, it means that here it means that the total value was 50,000. But if you do stock split, you want, let's say, 20 shares. Now this will be 20 shares, each at what? Each at what price? The price will reduce. It can't. You want to maintain the value as 50. So it means that to maintain the value as 50, the price has to reduce. It is reducing it what? You are getting 50,000, you are dividing it by 20. So it is reducing it to what? Who can tell me? 2,500. So each will be 2,005. Each will be 2,000. So you see that by doing the stock split, it means that the price of each share will reduce. So that is the impact. That is the impact. But all this, once the price reduces, these are the benefits you're getting. Okay? Affordability, liquidity, marketability, the confidence. But also the confidence depends on how the market interprets the split. All these things you're talking about, the advantages and all that, it will all really depend on how the investors interpret the split. As I told you about share repurchase. Okay, so we are done. We are done with our 14 marks. I really believe that when you meet this question, you are going to clear it when you are happy. Any question? Any question?
No, sir. I'm okay.
Any question? Monique, any question?
No.
Monique, are you seeing this?
Yes.
The total equity will remain the same. The only impact is that you may have more shares outstanding. Okay? You may have more shares outstanding. Like the same way we talked about here, you have more shares outstanding. So if you want to think beyond it, if you have more shares outstanding, this reduces what? This reduces EPS. Do you agree? Do you agree? Because here you are getting part over number of
shares.
Now this number of shares will be very high. You will have a higher figure, and that reduces what? That reduces EPS.
So it has no effect on the capital structure.
I really believe that it doesn't have an impact on your capital structure. Why? The total equity remains the same. Let's proceed to the next. Please review like theory. It is going to save us in an exam. And when you're reading these things around at times, you see theory is not coming out. At times, you may see that the theory is not coming out clearly. So let's see. Let's see this May 2019. May 20 what? May 2019 paper. I can tell I used not to discuss theory, but I have realized even reading the theory alone, we normally say that you go and read, but there are some points you don't understand when you're reading alone. Okay, so let's look at another question. You see the reason why I want the theory needs to be taken for granted. You have over 20 marks. advise whether Baganzi should proceed with the Mbayo transaction. So here you need to do the computation, which we are not going to do now. So here it is the computation, but the A, Roman 1 and Roman 2 theory, then part C discuss any 4 reasons why Mbayo acquisition may fail to enhance value of Banganzi and what stakeholders should do about them. So we have theory marks. These are 5 marks plus 4, 9 plus 8. Those are 17 marks. Part B is computation, which we are not going to do now. So we need to clear these, what? These 17 marks. If you are in an exam, can you really score those 17 marks? Of course, you're going to find that here, this is an entity called Baganzi Hotels Limited, which is a Ugandan company operating in the hotels and entertainment sector with a chain of hotels in major geographical regions of Uganda. So it's a Ugandan company. It's a Ugandan company. Baganzi is a Ugandan company. But they are telling us that the company has determined that they need to have an East African regional presence, like your entity. You may find that they want to expand. You want to have a presence outside Uganda. So the company has determined that they need to have an East African regional presence in the faith of increasing influence of economic integration. Okay, so that is something that you need to think about. They are telling us that Baganzi has had to expand rapidly over the last 14 years in order to exploit the opportunities brought about by the expansive oil exploration activities and tourism activities in East Africa. As such, the company's debt to equity. So that is computation, but I really don't want to focus. Whereas the board of directors has voted to enter the Tanzanian market, please pay attention here. Whereas the board of directors has voted to enter the Tanzanian market in the next 12 months, they have not yet agreed on the approach they will use. The main options under consideration are: 1, they should to establish a subsidiary from scratch. That is one option. One option to establish what? Establish a subsidiary. That is another one option from scratch, or to acquire Mbayo Hotels Limited, which has similar operations and whose current turnover is about Tanzanian shilling this. So you have 2 options. More information. The reason why you have this more information is for computation purposes. So now, examiner is telling you to discuss the advantages that you as an entity Mbayo, your deal will bring to Baganzi relative to the subsidiary approach to entering the Tanzanian market. Here you need to know whether you have understood the question. Before you even answer, have you understood the question? Who can tell me what are we trying to put? What are we trying really to answer here? Who can tell me what are we trying to answer? Who can tell me?
I think we are looking at acquisition as a corporate restructuring scheme. and a subsidiary. So we are looking at advantages of both and trying to push either of them.
We are looking at advantages of acquiring, advantages of acquiring what? Acquiring Mbayo, isn't it? What could be the, remember for you, who is you? You are called Baganzi Hotels Limited. So what are the advantages of acquiring Mbayo? That is Mbayo. Mbayo, that is what? Mbayo, that is Mbayo, of course, Mbayo, that is Mbayo Hotels Limited. So what could be the instead of establishing the subsidiary from scratch? Remember, when it's like they are telling you what are the advantages of acquisition, of acquiring an entity, or it's like mergers over organic approach, where you are starting something from scratch. Because if it is subsidiary, you are going to start from scratch. You are going to establishing a subsidiary. It means that you're going now to start from scratch. There is an entity that is already in existence. You have also another option of acquiring this. So let's see. Let's answer. I like these questions. Let's answer. We are going to start with advantages of acquiring Mbayo Hotels Limited. But of course, as we answer, don't forget the issues to watch out. Highlight any critical issues. You Baganzi, you the acquirer, you should watch out as you enter the Tanzanian market. What are those things that you should watch out as you enter this market? So let's start with A. Let's start with A. The advantages. I can simply copy here. We first deal with advantages of acquiring this entity. Instead of establishing a subsidiary, one, it could be that it would be easy, faster entry into the Tanzanian market. That could be point number one. Already the entity is existing. The entity is existing. Okay, so it means that acquiring Mbayo Hotels Limited would enable the Baganzi, right, to enter the Tanzanian market more quickly than establishing completely a new hotel business, than establishing a subsidiary from scratch. Okay, so this is because here, of course, you're going to write using your own words. This is because Mbayo already has operational hotels. They say similar operations. It has operational hotels. Already they have employees on the ground. They have the licenses. They have the customers. They have the suppliers already. Among others, the distribution channels. Already these ones are on ground. So if you acquire Mbayo, it will help you really because of these things that are already in place. So you as Baganzi, you would therefore avoid the lengthy process. You avoid the lengthy process of purchasing land, constructing hotels, recruiting, or maybe recruiting the employees, obtaining the regulatory approvals. That is lengthy process. So it means that you would just this acquisition will just allow you to begin the operations and earn revenue from Tanzanian market immediately after completing the acquisition. So it is something that you really need to look out. Then number two, there is an immediate what? There is an immediate, I can say an immediate acquisition of market share. There is an immediate acquisition of the market share. You as, remember here we are talking about Mbayo Hotel. Mbayo Hotel in Tanzania already serves a portion of what? A portion of the Tanzanian hospitality market. So by acquiring Mbayo, Baganzi would automatically gain access. Baganzi would automatically gain access to existing customers and share of the what? Share of the market. This is existing customers of Mbayo. Already Mbayo is on ground. Don't confuse this first point with this. First point is about faster entry into the Tanzanian what? Into the Tanzanian market. Faster entry. Faster entry means you have the hotels, you have the employees, you have the license, you have the customers, you have the suppliers, you have the... So here you are talking about too much things. But here our focus is on the what? The market. Customers are already there. It means that in the market, people know us, you exist. Instead of starting from scratch where you are going to hunt for customers, that one really can affect in terms of the market. Okay. So it means that here with point number 2, it means that it saves the Baganzi from having to attract all customers from the beginning. It saves you. You are not attracting the customers from the beginning. You are just trying to strengthen. Your aim will be just strengthen this one will actually strengthen you as Baganzi. It will strengthen your position, your competitive position in the Tanzanian market. Okay. I hope you have understood point number 2. I hope you have understood point number 2. Then next is that you are acquiring the goodwill. There is acquisition of goodwill and reputation. The acquisition of goodwill, which is really different, goodwill or the reputation. Remember, you are acquiring an entity that has been on ground, which is different from operating the what? Which is different from starting your own subsidiary there from scratch. Mbayo Hotel may have developed a good reputation through its service quality, or the location, the customer relationships, the experience in the Tanzanian market. All those ones are what? Contribute to your goodwill. So all that represents the goodwill. So you as Baganzi acquiring Mbayo, you benefit from the trust, you benefit from the loyalty, you benefit from this goodwill. Okay? And that really builds your strong your brand. It builds your brand and customer confidence, which normally takes many years when you're starting. If you're starting from scratch, it really takes many years to build the name. At times, it takes many years to build the name. But of course, here the reputation, we always bring it from the positive angle. If it has a negative reputation in the Tanzanian market, then at that point you put it under the merits. Because you may be acquiring an entity that has a negative or that has a bad reputation, which really can affect you. Okay, that is now next point. Then next you have access to local market knowledge. Access to local market knowledge, which at times you may not have when you start from scratch, because you have managers and employees of Mbayo on ground who really understand the Tanzanian customer preferences, the business customs, the tourism patterns, the employment practices, the government regulations. All those ones you may not be having them when you're starting from scratch in a country. If you decide to go the subsidiary approach, at times it is tricky. So it means that you as Baganzi, you would gain this knowledge through the acquisition. You gain this knowledge through acquisition, and that reduces the risk of making poor decisions that can be which screen are you seeing? I see you guys, which screen are you seeing?
working.
Okay, so we can say that this reduces what? I say that this reduces the risk of making poor decisions caused by unfamiliarity with the Tanzanian market. Yes, another person may argue that, but we are going to recruit workers. We are going to do the market research. Yes, you're going to do that. But remember, whatever you're doing now, that is an additional cost. That is an additional cost. And even there is a risk that people whom you are recruiting, they watch things on YouTube, they may not be having the experience. But here, Mbayo has workers already. And they know all these things in the Tanzanian market. And that one really helps you faster. Okay. Okay, then next, if it is acquisition, there is also acquisition of, you can't put it aside, acquisition of experienced management and employees. When you acquire Mbayo may be having those experienced managers and employees. Okay? Who understand the hotel operations, customer service, food and the beverage management, marketing, local business practices. So it means that Baganzi would not need to recruit and train an entirely new workforce. Of course, you may recruit, but not all workers. So retaining these experienced worker would help maintain the continuity of the operations and service quality, which would reduce the recruitment and training costs. You are avoiding also the avoidance of the startup costs. avoidance of startup costs. Establishing a new hotel business, like putting a subsidiary in a country, it means that really you're starting from scratch. It's like a startup. It's like a startup. So if you're establishing a new hotel business, that would require you as Bagans to incur costs. Probably you may find that you want to construct a hotel. You need to acquire land. You need to do the construction. You need to do the furnishing. You need to do the recruitment. You need to do the training. You need to do the advertisement. You need to do the installation of the information systems. All those are startup costs that you may incur. But when you acquire, when it is through acquisition, you obtain already operating business. The business is already in existence. So that operating business will be with most of the facilities and systems in the place. So that reduces the additional amount of expenditure that you would have to incur to enter the Tanzanian market. What else? What else? What else? Shorter time to reach the break even point. That is also something that you can look at. It is easy to do what? To break even. A new hotel may take a long time before its revenue becomes sufficient to cover its what? Operating and establishment costs. Break even, remember, at break-even point, we are saying that your total revenue is equal to the total costs. You have simply recovered the money you invested through your revenue. Through your revenue, you have been in a position to recover the costs you incurred. So it may take longer to actually recover your money when you start from scratch, because you would have incurred more what? You have incurred more costs. This would be because of why you are taking a shorter time, because you are acquiring an entity that has been in existence. So you attract customers very fast because of the reputation and all those things. So I believe that one is okay. Then we can also, what else you guys can we put? There are very many advantages. There are very many advantages. You are accessing, you have access to established supplier relationships, existing facilities. But here you can, because depending on how you explain these faster points, at times you can see you're repeating yourself. You have the operating synergies as well. The operating synergies whereby the Baganzi and the Mbayo may have different strengths that can be combined. You may find that Baganzi may have better technology, better financial systems, or management practices. That is Baganzi. Then you find that Mbayo you find that they have stronger local market, local knowledge, and customer relationships. So if you combine that, if you combine those strengths, it enables the merged business to really perform better than the two companies, how they would have performed separately. Because if you establish subsidiary, you're really doing it alone. You're really doing it alone as Bagans. But if it is a merged deal, if it is a merge as you're just acquiring the other thing, one entity coming together. So you find that really it will it will help. It will help. Okay. I believe the operating synergies, you have understood that. What else really can we add? The reduction of competition. Reduction of competition. Where Ambayo has an existing competitor or potential competitor, you acquiring it would reduce the number of independent businesses competing with Mbagans. So you really remember, if you establish there your subsidiary, you are operating alone. You are operating alone, and it means that Mbayo will also be in existence. Mbayo will be your competitor. Mbayo will be your competitor. You get that? So now you acquire Mbayo, your competitor. By acquiring Mbayo, you are reducing competition indirectly. That's what we are trying to do. Okay. You have the better bargaining power also, in that you have the greater bargaining power. The greater bargaining power. You guys, the reason why I'm putting many points, it is common. Yeah? This one, it is common. We are not, there are questions we are not going to discuss because I will have discussed them. So you have access to bargaining, greater bargaining power. How? Because here you are two. You get? You are two. So you form a larger hotel group. And that means that it provides more business to travel. You travel, you can be in a position to really bargain in terms of even the purchase, in terms of even in terms of how you negotiate the prices, the credit terms, how you negotiate, here. You negotiate the purchase, the purchase price. Here you have a better bargaining power in terms of negotiation of the goods to be purchased, in terms of the credit terms. If you want to purchase here, we are looking at it in terms of purchase. We are looking at it in terms of gaining the credit. All those things can help in terms of getting loan, because your asset will be high. The lenders can value your entity as a potential and compared to when you are alone. That is also something that you can look at, because your assets will increase. You have enough cash because you're two. So really the bargaining power, you will be in a position in terms of here you'll be purchasing. You can purchase more. You can purchase more. More purchase means more discounts. The suppliers will be in a position to give you some discounts and you save money compared to when you are alone. Okay, I believe these points are really enough, but there are very many. There are very many points that you can put. There are very many points. I believe you also know them. There are very many points, but every point you put, always know how to explain. But as you do this, yes, let's say you have acquired. You have acquired, or you have entered the Tanzanian market. There are things that we need to watch out. There are things that we need to watch out. As you enter the Tanzanian market, there are critical things that you need to watch out. Now, this question is not really specific that the method you have used to enter into the Tanzanian market. You can really just answer, because you may find that you have entered into the Tanzanian market through acquisition or through establishing the what? a new business. That is subsidiary approach. But whether you use subsidiary approach or the acquisition approach, you really need to watch out on some of the things. If it was through acquisition, then there are things that you needed to watch out. If it was through subsidiary approach, there are things that you needed to watch out. So the answer that you put really depend on your explanation. It will depend on your explanation, and your explanation should really be how you are going to enter into the Tanzanian market. How you're going to enter into the Tanzanian market, there are things that you need to watch out. If it is through acquisition, you're watching out things regarding not doing inadequate due diligence. Inadequate due diligence. You must, if you don't do this, you may find that Mbayo's financial statements are not really true. Those financial statements may not reveal all the risks facing the business. It may be, you may find that it may have the unpaid taxes, legal disputes, employee claims, damaged assets, excessive debt, unprofitable contracts. So if you don't do enough due diligence, then you can really struggle if you really fail to conduct a detailed diligence. You will struggle. These liabilities may become known afterward, after acquisition, and that can affect you. That can affect you when you enter into what? Tanzanian market. So do that. Even the differences in the what? The differences in the organizational culture. Also, that you need to watch out on that. If you're to enter into the Tanzanian market through acquisition, actually, even if you are doing a subsidiary, the organizational culture matters. How we operate, the culture we have in Uganda may be different. So you need to watch out on this. Now, if it is acquisition, you may find that Baganzi and Bio may have different management styles, employee attitudes, very different, reporting systems, very different, approach to customer service, how we serve our customers, very different. All these things can really affect. This can create misunderstandings and resistance among employees if you find that there are different organizational culture. So it's something that you really need to know. Things to watch out as you enter. What else can we put? Integrating systems. Whereby if it is through acquisitions, we have different accounting systems, different reservation systems, then reporting procedures, internal controls, all those ones may be different. And combining these systems may be very expensive and time consuming. You have to prepare a detailed operational and information systems integration plan. Watch out on that. Okay, watch out on that. What else?
But regulatory system and legal.
Different regulatory systems. And try to elaborate more. You understand your point? This is
You
a
may
different.
find like in case like a Ugandan company trying to acquire Tanzanian company, the way we operate, we have a kind of regulation, like let's say tax. But when we go to the other country, you may find they also have another tax system. So integrating our system, the way we operate here with theirs, may be a challenge.
That is true, but also those ones you can come here, and also you can even try to create another point like regulatory issues as you are trying to acquire. If the other entity has some more taxes, you need to think about that, or even the acquisition process, even if it is establishing a subsidiary. Have you tried to really understand the regulatory framework of the hospitality sector? Okay, the regulators, you may find that they press a lot of things and you end up not achieving your what? Even end up your setup may collapse or even not successful if you don't understand the regulatory bit of it. Then also there is a foreign exchange risk. You need to watch out on that because this is Uganda and Tanzania. So you need also to think about that in terms of the changes in exchange rates. All those ones may reduce the buyers if it is through acquisition. If it is through acquisition, fine buyer may earn revenue and incur expenses in Tanzanian shilling. While this entity in Uganda, you have Baganzi that reports in Ugandan currency. So these exchange rate changes may increase the cost of repaying foreign currency loans. So you have to watch out on that also on this issue. So you bring this point where the acquisition is not going to, where it is going to take place in another country. Okay? You should try to assess the foreign exchange exposure and consider the appropriate what? Risky management measures. Okay? Also, don't forget to look at the political bit of it, the political and economic risk. These are things to watch out. Every change in Tanzania's economic conditions, tourism industry, taxation, licensing rules, government policies, any change may really impact you. So here it is regulatory or legal risks, whereby you find that your transaction will need is what? Your transaction may need the approval from different authorities, different investment regulators, or different agencies, whether it is subsidiary, whether it is acquisition, you may need to involve those regulators. And failure to obtain the necessary approvals may delay or prevent the acquisition or even prevent your establishment in that country. Among others, we normally have differences. If you don't watch out differences in the service standards, really it can affect you as well, because we have different standards in terms of room quality, customer care, food preparation, cleanliness, all those ones. If you don't watch out on that, whether you are going to establish a new entity or acquire, if you don't do that, so here it means that one way is that you should appoint competent integration teams, establish clear targets, have and regularly monitor the performance of your operations. So that's what I can, but there are very many things to watch out. Eh? There are very many things to watch out. I believe you have that. So we are done with part A. Then part B, reasons why bioacquisition may fail. Reasons why this entity may fail. Enhance the value, the bioacquisition may fail to enhance the value of Vaganzi and what stakeholders should do about them. Now, reasons. 4 reasons, 8 marks. Let me copy this. Reasons, Remember, yes, you are acquiring an entity, which helps you to access the market with all those what? With all those benefits. But there are always issues, There are always issues. Especially where you find that there are wrong motives, there are unrealistic assumptions, there are poor implementation. Okay, now, one of the reasons may be around agents' problems. That and this is regarding management self-interest. That, remember, it is the reason why an acquisition may fail to provide the financial benefits to an entity. Okay? One, it could be about the agency problem, or another student can say management self-interest. How? Remember, the agent theory suggests that managers may sometimes make decisions that promote their own interests rather than those of the shareholders. That is agent theory, whereby you as managers, you're pushing for your own interests. You're trying to promote your own what? Your own interests, rather than those of the what? Those of the shareholders. You may find that managers of Vaganzi are supporting the acquisition. Why? It may increase. You may find that it increases the what? It increases the what? The size. It increases the size of the business. That's what they think. For them, they think that they are going to increase the size of the business, and once the size of the business increases, their status increases. Their status. When there is an increase in the business, remuneration is going to increase. They are going to have influence. Or it could be the control. All those ones as management. Okay? Now, you may find that management is really determined to complete the transaction, even when the acquisition price is very high, because they want to achieve their targets. They are not looking at what the entity is going to spend, the acquisition price. For them, they are looking at what they are going to benefit. So, if you are not really looking at the acquisition price, whether the acquisition, they may not look at the acquisition price, they may not focus on that too much, they may not focus on the expected financial benefits. If they are doubtful, all this will result in Vaganzi investing a substantial funds in a transaction that does not generate adequate return. I hope that one you have understood that point. And how can you safeguard Safeguard. Safeguard, how can you safeguard the agency or management self-interest? What can you do if you are to do the safeguard? Because they said any reason you state, put the safeguard. How can we avoid this issue, or how can we reduce it? Here the board and shareholders. All the shareholders should obtain independent financial, legal, or strategic advice before approving the acquisition. Don't rely on the management. Don't rely on the manager's view only. Don't rely on the management's assumption that we are going to achieve this. You should establish clear investment criteria. You as an entity, do you have investment criteria? You have to establish that, like setting up the minimum expected return, having the acceptable purchase price, looking at the minimum payback period, the maximum or the required. You compute those things of payback period. So you try really to have those investment criteria that you need. You should continue with acquisition where it has shown that there is likely to increase the shareholder value rather than merely expand the size of the company. You have those things that you really consider as an entity rather than just following these things. Okay, what else can we talk about? Another reason, we are done with self-interest, and we have done the safeguard. Put a point, explain. Here I have not really explained using those words, but of course I have talked about the management self-interest, and not for them not looking at what the entity is going to incur and what the entity is going to benefit. For them, they are looking at what they are going to benefit, not what the entity is going to benefit. That is point number one. Then point number two, what else? Why the acquisition may fail to provide the financial benefit. Point number two, poor strategic motives. Poor strategic motives. Number two is poor strategic motives. Where the acquisition may really fail, where this entity does not have a clear, you don't have the clear strategic. You as an entity don't have the clear strategic reason for acquiring bio. You may find that for you as an entity, you are just expanding because computers are expanding, or because it wants to build a larger business empire, without looking at other things, where the acquisition does not support your long-term objectives, where the acquisition does not support your bargains, you as bargains who is acquiring. If that acquisition does not support your long-term objective, your long-term objectives, then you will struggle. The two businesses may have limited compatibility. Okay, so you really need to, the safeguard here is that as you're trying to do this, establish here clearly establish how the acquisition supports overall strategy before proceeding. Don't just acquire. Establish the overall what? Strategy. Identify the benefits expected, having access to the market quickly, cost savings, new customers, strong brand, economies of scale. You look at all those things. If you realize that really they are okay, those are part of your plans. Like you want to gain access to Tanzanian market, you want to have new customers, you want to save some costs, you have to build a strong brand coverage, you have to enjoy the economies of scale. If all are part of your strategies, then you can go ahead. Then next, another thing is that people don't, in acquisition, you need to think about window dressing. It really affects, it causes these entities to collapse, to fail. The acquisition may be undertaken to create an appearance of growth, rather than to generate genuine financial value. Like, what do I mean here? You find that by combining the bio's assets, revenue, profits, with those of what? With those of bargains. Now, it will appear as if they have what? It will appear as if they have it will appear to be stronger. They will appear to be what? They will appear to be stronger in the short term. Window dressing. If we look at you as a group, you are okay because your assets, the other entities' assets, really you are okay. That's why even the banks may go ahead and give you a loan, because your total revenue, profit, you seem to be okay. That is window dressing. However, the picture, okay, window dressing, we are saying your picture looks to be okay now. But you needed to know that you need to think about how you're going to do what, how you're going to perform going forward. That transaction may make your financial statement look better temporarily, but it weakens your long-term financial position. Going forward, because you are going to realize that when Imbayo is acquired, let's say when Imbayo is acquired at excessive price, when Imbayo is acquired at a higher price, what will happen? this will, or maybe when bio is acquired, when it has a weak underlying performance, or it has a weak performance. This will really mean that in the long run, this will reduce the EPS. Profits will not go, will not do well. There will be, you will not perform well on return on capital. Return on capital employed will not be okay. Return on capital will not be, on capital employed will not be well. Employed will not be well. Your cash flows may be affected. You struggle with liquidity. So all of this in long run, they can have impact. They can have impact. Yes, in short term, you are okay, but in the long run, there will be issues around this. There will be issues around this. There will be issues around this. So how, and of course, whenever there are issues around this, it means that overall the long-term financial position will be weakened. Now, safeguard about on this window dressing. Safeguard is that you must evaluate the acquisition using long-term value measures, rather than focusing on growth in a revenue, rather than focusing on growth in assets or marketing size. You have to look at beyond that. You need to think beyond that. Think beyond that. The body should establish where the acquisition will improve, the cash flow. What are the expected cash flow? What is the expected return on the investment? Look at those things. What is the expected EPS? What is the expected share value, shareholders value? After taking into consideration the acquisition cost, the integration cost, the financing cost. You need to think about those things after taking into consideration the acquisition costs, integration costs, the financing costs, among others. So what will be the shareholders' value when you take into consideration all those things? So that's how you can do with window dressing. The picture now is good, but in the long run, that picture may be weakened. That's what we are talking about. Window dressing, now the picture is good. The financial statement looks good. You overstate maybe the revenue. In terms of reporting, we may say that maybe figures are inflated. Overstated the costs, the revenue, and you overstated the revenue, you understated the expenses. That is window dressing to improve your profit. You overstated the assets because you want to get a loan so that the lenders can see that you're doing well. That is window dressing. But in the long run, how will you maintain that picture? Will that picture be maintained? Okay, so that's really something that you need to know. So here you will need to have the financial forecasts. Those financial forecasts also, these financial forecasts, the expected cash flows should be independently independently reviewed to ensure that they are not prepared merely justify the transaction. That's why you see entities are getting the auditors to really do what? To really try and assess. They do these forecasts. Try to do the analysis around these forecasted cash flows independently. What is the spelling? Independently. So that's at times that's why you will see the acquirer trying to do the due diligence and trying to also engage the financial analysts, even in the other entity trying to also present the information regarding the audits of those forecasted cash flows. Okay. What else? What else? We have how many points? Yet we have 1 to 4, but we can have like another point would be failure to consider customers. As you do this, when you don't put into consideration the customers' preferences, can affect you. The customers of Mbayo hotels may not automatically remain with the business after acquisition. Please, you need to put into consideration those things. Failure to consider this. It may be they may be loyal to the existing brand. But you find that these customers, for them, they really want to really do what? To remain with the other buyer. Now, what will happen is that whenever there is acquisition, probably there will be slight changes in prices. There are changes in prices. Changes in what? Changes in prices. There could be issues around services, changes in the service, how you're offering your service, the branding, the operating procedures. Whenever there is acquisition, there are those things. And because of that, without considering the customer's expectations, customers may become what? Dissatisfied and move to the competing hotels. If you change the price after acquisition, you change the way you serve the customers, how you brand your things, all other operating procedures are changed. Now, that one can actually cause problems. And remember, the loss of customers reduce revenue, reduce profitability, and all that you end up not getting the financial benefit that we are talking about here. Whenever there is low profits, low revenue, that financial benefit you are not going to get. How can you safeguard this? Safeguard here. Put a point, explain a point, how it can. As you explain, please keep in mind about the question, how the acquisition may fail to provide the financial benefit. So explain your point. Explain your point very well, how that may actually not provide the financial benefits to an entity. Okay? Then after that, you do the what? You do the what? The safeguard. A safeguard here could be that you as Wagans conduct the what? Conduct the customer research before and after the acquisition. Before and after acquisition. Why you need to understand the factors that customers value. You need to know the major customers, the corporate clients, the travel agencies, all those things should be informed. Also, the customers, inform the customers. Customers of Mbayo should be informed. Should be informed about the acquisition. But as you inform, assure them that the service quality will be maintained or improved. It's not just about informing them that there was acquisition. It's not about informing them that there was acquisition, but you need to go ahead and tell them that the quality will be maintained or improved. Also, another thing safeguard is that you should avoid you as after acquisition, avoid making certain changes to the Mbayo brand, to the price, to the pricing, service delivery. Don't immediately change. It is in pola. You do these things in pola until the customers understands, or until you understand how customers are likely to respond. Don't just change things before you understand how these customers are going to respond. The customer complaints and satisfaction levels should also be monitored closely. Receive feedback, try to gather feedback and respond to those things. What else? Poor planning can also cause problems. Point number 5, poor planning can cause problems. Poor planning. The acquisition may fail where the entity Baganzi does not develop, where you are not developing a detailed, where you don't have a detailed plan, where without a detailed plan for integrating Mbayo's employees, Mbayo's systems, Mbayo's assets, Mbayo's operations, among others, management, etc. If you don't really have the detailed plan, then that one can cause a failure. Poor planning leads to what? Now you first state a point. But of course, here we are looking at the financial benefit. We are looking at the financial benefit, how the acquisition may fail to provide the financial benefit. You don't have the plan for integrating all of this. So poor planning. Now you're trying to state how this can affect how can this lead to, how can affect the financial benefit? Poor planning lead to what? Poor planning may lead to delays. Delays, that is number one, may lead to duplication of duties. Duplication of duties may lead to conflicting decisions. Conflicting decisions may lead to increase the costs. All these ones may lead to interruptions. All these ones have also understate the time required to introduce new systems. All this, where integration systems become high, then you're reducing the costs, so you're reducing the benefits. That all this has an impact on what? On the return. Where there are delays. Where there are delays, you're not serving customers well. They are reduced revenue. Duplication of duties, meaning that what will happen is that there is no efficiency. There is no efficiency, redundancy. You're incurring costs for nothing, which you would have reduced, and becomes a benefit to the entity. Conflicting interest. You really know that conflicting decisions, as we said. The other entity is saying this for you, are saying this. Time wastage has an impact on the return. So safeguards, all this has, so as you're talking about financial benefit, you're looking at the return and also the cash flows. How is the cash flow affected? And how is your profits affected? So that is how you try to do. Then the safeguard. Hey, you guys will have only 4 points. Hey, this is number 4. This is number 5. Then safeguard, what can we do, guys, here? Safeguard, what can we do? Prepare a comprehensive acquisition and integration plan before completing the transaction. Before completing the transaction, you prepare, identify the expected costs, the incurred, identify the sources of finance, identify the integration responsibilities, identify the deadlines, implementation deadlines, and then have the performance targets. All these ones you must have. Don't just move anyhow. You should carry out a detailed what? Carry out a detailed due diligence. Carry out a detailed due diligence. And have and prepare alternative plans for situations where assumptions fail to materialize. You should really do the progress. Progress should be reviewed. Progress should be regularly reviewed so that problems are identified and corrected. So in an exam, you don't need to put all these safeguards because there are 8 marks. You put a point, explain it, then you put one safeguard, you move on. But in case you can recall some points very fast, put them. if you really know that you're very fast. Okay. What else? What else? Failure to do enough due diligence. You can separate that point. Inadequate due diligence, where you are not doing inadequate. Number 6, where you are not doing inadequate, where you are not doing inadequate due diligence. There will be issues. Failure to identify the hidden, failure to identify hidden problems in the other entity, in the bio can cause the problems. Such issues would be unpaid taxes, unpaid employee claims, unprofitable contract, damaged assets, overstated revenue, overstated assets. All those ones can really cause what? Can really cause problems. So how can you safeguard around this? To conduct what? Safeguard around this is that you need to really do a thorough due diligence. Safeguard. Oh my auntie, boy. Safeguard is you do what? You should conduct. You should conduct a comprehensive due diligence. A comprehensive due diligence. So you look at the financial, you look at tax, you look at legal, you look at operational, you look at commercial, you look at human resource, etc. So don't just look at only one aspect of financial and you know all things are okay. Okay? So you need to bring in independent what? You need to bring in independent experts who should verify the financial statements, who should verify the tax compliance of the other entity. Bring experts. Also, the acquisition agreement, the acquisition agreement should also contain warranties and indemnities requiring the seller to compensate us as bankers for material liabilities that were not disclosed before completion. Make sure that you have this. Make sure that you have this in your agreement. If you don't disclose something and it affects us, you compensate. Okay. So these are some of clear points that you can really make. And maybe the last one, as we conclude, failure to realize the expected synergies. There are also issues, failure to realize the expected synergies. That is another point. Whereby you as the acquirer, the bankers may expect the combined business to generate. You expect to generate cost savings. You expect to increase the revenue. You expect to increase revenue. You expect to have an increased operational efficiencies. All these may be overestimated. All these may be overestimated or may take longer to achieve than anticipated. So you may find that you expected to reduce costs through joint purchasing. You thought that if I acquire, you will be in a position to have those bargaining powers. You expected those through joint purchase bargaining power. You expected the shared marketing. You expected this centralized administration. But now there are also issues where suppliers may refuse to do what? To reduce the price. You expected that they will give you discount because you are purchasing in large quantities. But suppliers refuse to do what? To reduce the prices. You find that they are incompatible systems, which may be really expensive to combine. Or they are duplicated employees, which may be costly to terminate. There are those duplicated, like you find that they are redundant jobs. But to eliminate them, it's costly. You have identified that these guys really they don't have too much to do, but because of those employee claims, you ended up paying too much costs to eliminate them. So what can you do? Remember all these things that I'm talking about. Whenever you find that you have not reduced the suppliers have not reduced the price, you expected to save. You have not saved. You expected the customers to increase. They have not. You expected maybe in terms of systems to integrate easily. Issues. All of these will have an impact on the cash flow, will have an impact on your profit. And where the expected synergies do not arise, it means that the profits generated may not justify the price paid. And that affects. So safeguards, I think I should stop on this. Safeguard, go ahead and identify the expected synergy before the acquisition, and estimate both the benefits and the costs to achieve, and the costs required to achieve that synergy. Yes, you see that there is a synergy, but have you estimated the benefit and the costs required to achieve that? The estimates should be realistic and supported by evidence rather than general expectation. What have you based on to get those expected cash flows? What have you based on? Remember, we always have those estimated cash flow that after acquisition, we are going to have we will be in a position to have these expected cash flow. Year 1, year 2, year 3. What have you based on to do those estimates? So the responsibility for achieving each synergy should be assigned. The responsibility for achieving each synergy should be assigned to specific managers or specific workers with clear deadlines and performance measures. It is something that you need also to consider. Yes, you are saying that we need to achieve the joint, we need to achieve, let's say if it is about to increase revenue, who should take that, and what should be the target, what should be the measures. Okay. So among others, we talked about customers, but you needed to talk about employees. Don't forget about that loss of key employees after acquisition. It is something that can affect the market economic changes. The market and economic changes can as well can lead to failure. The technological changes, technological obsolescence can as well have an impact. All these ones, I believe these ones you can explain. Can you? If you can explain them, then we can stop here. All these ones can affect. Can you explain them? Now, when you look at the technological obsolescence, you are talking about issues like reservation systems. Those revaluation systems, accounting system, software, security systems, or other hotel facilities may become outdated shortly after the acquisition. You get, those ones may become outdated shortly after acquisition. And you may find that you incurred substantial and okay, you may find that now once they are outdated, then you have to incur substantial money to replace or upgrade them as bankers. So you incur substantial amount of money to replace or upgrade. And if those costs were not considered in the purchase price, then the acquisition may generate a lower return than expected. So how you should safeguard that is that you conduct also here you conduct technological and operational review during what? During the due diligence. Conduct the technological and operational review during the due diligence. The costs required here, the cost of required upgrades should be included in the acquisition evaluation and integration budget. You make sure that you have all those things in your budget. That is the technology, but also market and economy. You will find that there are changes in the Tanzanian market here. If there are changes in the Tanzanian hospitality market or tourism industry, or the customer preferences have changed, there are changes in taxation, government regulation, all those ones can have an impact. Like, let's say decline in tourism, a sector, there is, let's say, increased competition, high hotel taxes, economic recession, all those ones may reduce occupancy rates and room prices. and that affects your actual cash flows, lower your profits. So how can you safeguard that? Conduct a detailed market and economic analysis before proceeding with the acquisition. You conduct a detailed market and economic analysis. Those financial projections you are making should include pessimistic, should include realistic, and optimistic scenarios. You should diversify your customer base. Diversify your customer base between tourists, business travelers, conferences, local customers. Don't focus on only one segment of customers. You diversify. That's how you can safeguard that. Diversify your customer base across. Okay. Then regarding the employees, of course, acquisition may create uncertainty among the buyer's employees, managers, and other staffs because of the fear of redundancy, demotion, loss of authority. All those may lead them to resign. So if you lose experienced managers, experienced chefs, sales staff, it means that that can really affect. You are losing valuable knowledge, and those guys, the relationship with your customers, the suppliers, you find that is affected, and you need to add additional costs to recruit, train new workers. All that can have an impact on the operation. There will be also disruptions, which reduces service quality and delivery. So how can you safeguard? Identify employees who are important to the continued success of the environment, and communicate with them before completing the acquisition. You identify those key workers very fast. Have retention bonuses as another measure. If you remain with us, you're going to get this money. So have retention bonuses in place. Have improved the career opportunities. Have have suitable employment contracts to be offered to them. Also prepare a succession plan to reduce over-dependency on a few individuals. You must have succession plan in place. Okay, so I believe I have answered these two questions in details, and you will always pass your questions if you need such a kind of a question. I believe that's enough for now. Really, I always like you understand. That's why at times I try to explain. Any question? I'm done. Any question?
No questions. Thank you so much.